Good morning and good afternoon, ladies and gentlemen, and welcome to the Millicom Financial Results Conference Call. Today's presentation will be hosted by Chief Executive Officer Mauricio Ramos and Tim Pennington, Chief Financial Officer. Following the formal presentation by Millicom's management, an interactive Q&A session will be available. I would now like to hand the call over to Michel Morin, Millicom's Head of Investor Relations. Please go ahead.
Thanks, Hannah. Hello, everyone, and welcome to our third quarter 2018 results conference call. Before we begin, as usual, let me draw your attention to the safe harbor disclosure on slide 2 of the presentation, which is available on our website. With that, let me hand the call over to our CEO, Mauricio Ramos, for his prepared remarks. Mauricio?
Good day, everyone, and welcome to our third quarter call. As always, I'm here today with Tim Pennington, our CFO. Once again, we had excellent results this quarter. The key highlights are on slide 4. 1, the strong operating momentum that we saw in the first half of the year continued into this third quarter. 2, Colombia had another very, very good quarter. Cable is working there, and so is mobile. 3, our home business continues to perform exceptionally well. We continue to grow above 12% this quarter again. And 4, the integration of Cable Onda is actually already underway. So let's get to the details beginning on slide 5. We continue to perform very well this quarter. Our LATAM service revenue grew 4.7%. We had anticipated a bit of a slowdown in the second half, but as you can see, we delivered another quarter of growth above the top end of our revenue guidance. We're pleased with the results for sure, but what is really important is that this growth is fueled by healthy, long-term, data-driven businesses like cable, mobile data, and B2B. The stuff that we have been focused on for the last 3 years. All of our 3 businesses, as you can see on slide 6, had positive growth yet again in Q3. B2C mobile continued to grow, fueled by 4G and mobile data. Home had another exceptional quarter. It is now showing its true anticipated potential with sustained growth of 12% again. And B2B continued to deliver mid-single-digit growth in line with recent trends. All growth engines are now delivering, with cable leading the way as we had anticipated it would. Now let's take a look at some of the KPIs, starting with mobile on slide 7. On mobile, as you can see on the left, we continue to add about 3 million 4G customers per year, and we now have over 8.6 million. This is, however, still less than 30% of our total base, so we still have a long way to go here. And as you know, we get a good pickup in ARPU when customers upgrade from 3G to 4G. On the right-hand side of the page, you see the results of our focus on postpaid mobile, something that I have been mentioning a few times already in the last few calls. So far this year, we have added 135,000 mobile postpaid subscribers. That is 3 times better than it was last year and our best year since we can remember. When done correctly, migration from prepaid to postpaid is an important strategic opportunity, one that it is in the early days for us in many of our markets. So stay tuned for more of this. It is consistent with our focus on more and more subscription revenues. Speaking of which, let's take a look at the home results on slide 8. The chart simply reflects the strong pent-up demand for broadband and pay TV services in our markets, the opportunity we have talked about so very often, and the reason we have been building so much cable. Just in the first 9 months of this year, we have added over 300,000 new HFC homes connected as subscribers. That was actually the target for the full year, and that is why we upgraded that target to 400,000 new cable subscribers for the full year. And as you can see from the results in Q3, we're well on track for those 400,000 net adds HFC. The rate at which we add net RGUs is also increasing. We're bundling up new and existing customers. This is good old cable tactics. And as you move to the right on this page, you can see that strong customer intake is not diluting home ARPU. We're actually adding subscribers while we're also growing ARPUs. This is because we have and we use our pricing power, but also because we're upgrading speeds and offering new services. So with the results that strengthen our confidence, we have continued to expand the cable network even faster than we had planned for this year. We're now on track to build 1.2 million homes passed, a higher build than our original target of 1 million additional homes passed for the year. So we will build more homes passed and add more home subscribers than initially targeted for this year. And we will do that without raising our CapEx target, as Tim will discuss in a bit. We're simply getting better and faster at building these networks and at connecting subscribers. These results simply underscore why our target to build at least 5 million more homes to get to our 15 million target just makes so much financial sense. Let's take a minute on Colombia on slide 9. As you will hear from Tim later, revenue growth in Colombia was solid again in Q3, and our margins there are also trending higher. Much of this improvement is visible in our home business. In Colombia, we have built a ton of new cable networks and replaced a ton of old copper networks. We have launched next-generation TV services, and you might recall that a year ago, we also told you that we were investing in sales and marketing. Well, these are the results. On this slide, you can see clearly on the left that our HFC net adds in dark blue are accelerating, and that churn on our legacy copper network in light blue is decelerating. And on the right-hand side of the slide, you can see that ARPU is growing. When we upgrade a copper home to HFC, we upsell digital services on that new network that we previously could not sell. You know that we have been optimistic and bullish and focused on Colombia for a long time, and it should be clear by now that our strategy is working. Colombia is growing, and Tim will show you a little bit more of how that's translating into the financials. And we're not done yet. As you can see on slide 10, we recently launched new mobile postpaid plans in Colombia. The name of the game for us now in mobile in Colombia is simplicity. We used to have 12 plans. It was confusing for our customers, and it made life difficult for our salespeople and our customer care agents. So we pulled a page out of T-Mobile's playbook, and we decided to take bold action by offering only 3 plans. Our customers now know what they're getting, and they feel like they're getting what they're paying for. As a result, our NPS is already trending up strongly. This new offering is indeed pulling in postpaid plans that are bringing in higher satisfaction and, we believe, lower churn and a higher lifetime value over time. You know this playbook. You've seen it play out elsewhere. New plans are structured in a way that gives our customers more data than before, and we do that in exchange for an ARPU pickup. Having said this, it is still very early days, but so far, we like what we're seeing in Colombia on mobile as much as we do on home. So now let me come back to cable for a minute, big picture and strategically, beginning on slide 11. There is a lot on this page, but the message should be pretty clear. Our cable business is getting pretty big pretty quickly. If we look at our HFC business, you can see that homes passed, homes connected, and RGUs have all been growing double digits and consistently over the past 3 years. And revenue growth itself in dollars has been accelerating as well, and much more so over the last year when all the momentum we have building has started to translate into revenue. We now have double-digit growth in our home business. Now please turn to slide 12. The point here is simply just how big our growing cable business already is. When you include Cable Onda, we already have more than 10 million HFC homes passed and about 4 million homes connected with about 7 million RGUs. And when you look at our cable business as a whole, which is the sum of our residential cable business, which we call home, plus the fixed B2B business, plus Cable Onda, then you get a clear picture of the sheer size of our cable business. Our cable business is already a $2.2 billion cable business within Millicom. And as I looked at in the prior slide, it is growing pretty fast. Now, for those of you who like valuation math like I do, put a cable multiple, any cable multiple you like on that $2.2 billion of cable revenue. Then do a sum of the part valuation of our company. And when you do that, you gotta believe, like I do, that the market will, sooner or later, just realize the sheer size and growth of our cable business and the long-term value we're creating here quietly. And that brings me to the next slide, number 13, the cable math or the cable economics. Some of you will have heard me say this before, so apologies for that. But the cable economics for us are really, really good, and we think it makes sense to just go through them again. We spend about $100 to pass a home. We then spend an incremental $150 to connect the home. And we connect 1 of every 3 homes that we pass. In some countries, we already do much better than that, but we think that 33% is a reasonable network penetration assumption going forward. So our overall cost to build and connect is pretty cheap by global industry standards. That's because densities are high, the network is almost 100% aerial, and labor is relatively cheap in our markets. We then get a $30 ARPU per home per month, and you have seen in our performance in the past 2 years that we do use our pricing power, even in dollar terms. So, a bit more math, plug these numbers in, and take LATAM cable industry averages for churn and for EBITDA margins. The outcome is a pre-tax return on investment north of 30%. That's a cash-on-cash payback in less than 3 years, which is why we have built over 3 million cable homes passed in just the last 3 years. Now, these are what I call standalone cable economics, but Millicom is not a standalone cable provider. We're typically the market leader in mobile, so we have a massive market income already in market. We have very large distribution capacities everywhere we operate, and we already have top talent already in place there. And we also have one of the most recognized brands in all the countries we operate in. This simply means that we have higher than standalone EBITDA margins in our cable business because it's not a standalone cable business. A lot of the G&A is already paid for by the existing mobile business. And crucially, on top of this, these investments also position us for convergence, for 5G into the future, and also already support our B2B opportunity today. All of this is why we're investing with such conviction in cable. And this is why I was so happy that we were able to take advantage of our strong financial position to acquire Cable Onda. This company, as I hope you realize by now, is a gem. There's no other way to describe it. And Panama is a great country for us to diversify into. It is dollar-based, high growth, high GDP, and stable. As you can see from slide 14, I was in Panama just a few days after we signed the acquisition. I met with the team, with our partners, with the media, and with President Varela there. Let me share a few key takeaways from that trip. One, what a great operating team to incorporate into our portfolio. There is a ton of advanced cable expertise in the team in Cable Onda. This is a more developed cable market than most we operate in. DOCSIS is further along the way, so are speeds and so are Wi-Fi deployments. We will, as a company in Millicom, benefit way beyond the hard synergies from incorporating this talent pool into our cable expertise and by using it elsewhere where we operate with cable. Two, Millicom has been welcomed in Panama already by the authorities. There will be, of course, a normal approval process, but we're already a welcome new player there. I came away convinced that our regulatory review is well on track. We expect to close still before year-end. And this is key because this short time frame between signing and closing highly reduces M&A integration risks. That's a delicate and risky time of uncertainty between signing and closing that in this case will be very, very short, minimizing our risk there. And three, because there are no jump-the-gun antitrust issues for us in Panama, our teams are already working together as we speak, hand in hand with the teams in Panama to build our own jointly developed 2019 budget so as to a quick wins on synergies. And this also means that we will be hitting the ground running as of January the 1st, 2019. And finally, let's look at slide 15. You all know that we have been squarely focused on cash flow generation from day one when we joined about 3.5 years ago. And we have been so every day as we were turning the business around, both operationally and financially. And while we were building those 4G and cable fiber networks, we had our eye on the cash flows. We know we need a strong cash flow. We know we need a strong balance sheet to keep building these networks that we have been building. And we clearly would have not been able to acquire such an amazing company as Cable Onda had we not had our eye on the ball. Without strong cash flow generation and without a good balance sheet, the strategy makes little sense. So this slide on my section is simply to say that we got our eye on the ball. Strategy, if good, must lead to equity cash flow. And ours has been a turnaround of over 400 million so far. And here's the punchline. It is again up this year, 19% year to date. With that, let me pass it over to Tim. Tim?
So let me start as usual by setting out the key financial highlights on slide 17. So picking up from Mauricio, we have significant KPI-led progress, which is clearly driving the revenue growth. Basically, as we set out in the strategy, rapid 4G network build, the migration of mobile subscribers to 4G, the accelerated homes passed build, and the increasing rate of homes connected. And this is driving not just service revenue, but also EBITDA. And this is tough. Increased network brings increased cost. Increased customer acquisition brings more cost as well. And servicing these customers brings more costs. but our EBITDA is up, as were all of our profit metrics. And cash flow also ended the quarter a lot better than last year, leaving us in a better balance sheet position. So in short, we're well on track with our 2018 goals. So let me turn now to the key financial metrics on slide 18. The group service revenue grew by 4.2%. It was driven by LATAM. There was a decent performance in Tanzania, but overall Africa was slightly down. Even so, our EBITDA was up 2.6% to $564 million, and OCF, which is our EBITDA minus CapEx, remained above that 20% target once again. Please note that the recently announced acquisition of Cable Onda is not included in these numbers, and as Maurizio said, we expect the deal to close by year end. So let me take a closer look on the group EBITDA on slide 19. In this quarter, FX impact was modest despite the currency volatility around us. The group EBITDA grew by 2.6% organically, and most of the pickup was from LATAM. You can see on the slide $22 million of the pickup, and it's largely from Colombia, Guatemala, Paraguay, and Bolivia. In corporate, we had an adverse movement. This is mainly one-offs, including a reorganization charge. Despite this, we were still able to increase the group EBITDA margin by 70 basis points to 37.7%. And we can dig a little deeper onto the LATAM business in the next three slides, starting on slide 20. First, the headlines. You may recall that we had an exceptional Q2, driven by the one-off B2B revenues in Colombia. In Q3, we were more or less back on the trend line, resulting in the underlying LATAM service revenue growth of 4.7%. Now, there was a little bit of noise in the LATAM revenue numbers, as we've reclassified some international third-party wholesale revenues in Colombia onto a net basis under IFRS 15. This affected $13 million of revenues in the quarter and $70 million year to date. There was no reclassification in the prior year, which was under the old standard. So the growth rates are presented here on a like-for-like basis, and it had no impact on EBITDA. And to follow that, EBITDA up 4.2%, and we made good progress on margins of 120 basis points to 38.4% in LATAM. Finally, OCF up once again despite $18 million of higher CapEx. So look at the service revenue progress in more detail on slide 21. You see that our South American operations are all performing well. Bolivia continues to knock it out of the park. Colombia grew by 4.4%, supported by the growing home business, and Paraguay, which faced a 21% MTR cut late in the quarter, still produced service revenue growth above 5%. Now, had that MTR cut applied to the whole, the underlying growth in Paraguay would have been impacted by around 50 basis points. Central America, El Salvador faced further challenges as we've continued to focus on addressing the operational challenges. We've taken steps to lay the foundations to deliver sustainable growth in 2019. Guatemala maintained the level of growth achieved in Q2, benefiting from data revenue. And also, as we flagged, Honduras is beginning to show some strength with a 2.6% year-on-year growth on better mobile performance. And following the recent trends, Colombia, Bolivia, and Paraguay all turned in strong EBITDA growth, which is shown on the last part of slide 22. Last year in Colombia, we took on more costs to drive the home business. We've now been able to realign our cost base, and with revenue growth, EBITDA grew 13.7%, with a margin of 440 basis points, and the bulk of that increase is coming from the underlying performance. So that remained impressive, up double digits again, and Paraguay up nearly 8% with a 49.4% margin. With a shade under 5% growth, again, hugely impressive achievement, and our business at sustained EBITDA margins north of 50%. As I just said, El Salvador was impacted, the EBITDA was still impacted, but about half of it relate to one-offs, with the rest just following the revenue impact. And finally, in Honduras, there was a bit of noise again in these numbers, but normalizing EBITDA was up 3.7%. Let's look at the costs in more detail on slide 23. And if I include the impact of IFRS 15, organic operating costs increased by 3.4%. Now, sales and marketing costs declined by 4%, but if you recall last year, we had a spike when we hired around 1,000 salespeople for home. G&A increased by 9.6%, but most of that has actually come from one-offs, including that head office reorganization charge. And despite this, our trading margin is up 130 basis points. A quick look now at the P&L for the slide 24. D&A, net finance charges and taxes were all lower in the quarter. D&A benefited from the roll-off of amortization and respect to intangibles. The net finance charge, absence of early redemption premium, and tax was just a tiny bit. Again, I want to note that operating profit was up 17%, pre-tax profit up over 22%, and net income up more than twofold. Turning now to slide 25 and the cash flow for the first 9 months. Cash flow from operations have increased by 51 million to almost 900 million, with the increase coming mainly from improved working capital and from lower capex. Over the past 2 years, we've implemented numerous cost savings under our Project Heat initiative. These have helped lift margins, contain working capital, and minimize capex required to grow our business. So when you look at the P&L, cash tax, in contrast to the P&L, cash taxes increased by 26 million, again on timing differences. Net finance charges declined by 48 million, and dividends to minorities increased by 34 on an increased dividend paid by Guatemala. And as a result, year to date, as Mauricio has made clear, our equity free cash flow has increased by almost 19% to $243 million. Turning now to our capital structure on slide 26. At the end of the quarter, our net debt stood at $3.8 billion, representing proportional net debt to EBITDA of 1.82 times. That's quite a meaningful reduction from the 1.95 times at the end of Q2, and the changes reflect increased cash flow and proceeds from tower sales. Note that we pay the second part of our dividend in Q4, and that will take us to around 2 times. And we said that on a pro forma basis, the Cable transaction will take our leverage to around 2.5 times. Finally, on slide 27, the debt profile pro forma for the issue of the 2026 bond. We issued an 8-year bond to slot into our maturity profile gap in 2026, and this takes our average maturity to 5.6 years. Let me bring it together now on slide 28 by looking at our outlook for 2018. In short, we're well on track. LATAM operations have generally performed strongly through the first 9 months of 2018. We have raised our target for HFC homes connected last quarter, and we're on track. And we now expect to add 1.2 million HFC homes passed, up from the 1 million previously announced. We're on track to add 3 million 4G customers, and our postpaid net adds are the strongest since 2015. And as a result of this strong commercial and network expansion activity, we continue to expect the LATAM service revenue growth to be around 4%, and the LATAM EBITDA growth in the target range. Our capex in LATAM is unchanged at approximately $1 billion. So let me recap. Our strategy is working. It's bringing sustained growth. It's driving through strong KPIs to solid financials, and our outlook is on track. And our cash flow is growing. We've made important strategic moves in the quarter to enhance our cable business through the acquisition of Cable, and we're pushing ahead to list in the US on NASDAQ Exchange. And with that, we'll now open for questions.
Thank you. Ladies and gentlemen, we will now begin our question and answer session. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. We'll now take our first question from Julio Arceniegas from RBC. Please go ahead.
Yes, afternoon. Thanks for the question. So, Mauricio, postpaid penetration in Colombia is very low. MIC only has near to 10% of its base in postpaid. However, the company launched a few weeks ago a new postpaid portfolio, which actually I see that is very competitive versus the prepaid product. can you give us some color on the acceptance of the market to this new portfolio? And do you see an acceleration of prepaid to postpaid migration in this market? And my second question is also regarding Colombia. Broadband speeds in Colombia, actually, the demand is actually quite lower than the other countries in the region. However, it seems that consumer confidence in Colombia is improving. Are you seeing higher demand in the market for higher bandwidth that at the end is going to have a positive impact in I don't know, ARPU? Thank you.
Yeah, thank you, Julio. I think you read it well with regards to the opportunities in Colombia. And what we're doing is precisely taking advantage of those. On the postpaid question, indeed, for a market like Colombia, which has a relatively high GDP per capita, growing middle class, a young population, and where demand for mobile data and fixed data is on the rise, indeed there's a tremendous opportunity to drive migration from prepaid to postpaid. And that is exactly what we're doing. That's exactly what this product is all about. It's about driving precisely the move from prepaid to postpaid. And we think we've hit it right on the spot on the way to do it, because we are seeing quite a bit of interest, and not only from our own prepaid subscriber base, but also from different elements of the postpaid subscriber base that are seeing a much cleaner, better product. I can't really speak too much as to the take up on demand on the market, because it's just a extremely competitive product out there, and we like what we're seeing so far on the mobile. We think it just adds to everything that we've been doing in Colombia. And on Colombia, now on to the fixed broadband speeds, again, you've seen us consistently bring up speeds everywhere we operate, but also in Colombia. And we do that, and this is a good old playbook, we do that as we take up the advantage of bringing prices up. So it's a combination of higher ARPU in return for higher speeds and a better product. And in Colombia, we've been doing just that. It's a combination of building the plant, upgrading the networks, decommissioning some of the copper, moving the subscribers from copper to HFC. That gives us the ability to sell higher speeds, pick up a little bit on ARPU, and we do that while also expanding the network. And indeed, Colombia is a market where the need for speed will continue to go forward. These are bandwidth-hungry consumers, both on mobile and on fixed. So the combination of postpaid with quote-unquote unlimited for mobile and an upgrade in HFC and selling higher speed is the right mix for this market. You know that we've been always bullish on Colombia. We may have even at points found it like a little bit of Don Quixote, fighting the unwinnable battle. And I think at this point in time, it feels like the winds are turning. We've invested in network building. You've seen us build cable. You've seen us build 4G. We've invested in IT. We brought a lot of talent from elsewhere to put into Colombia to strengthen that fantastic team over there. We've launched next generation TV. We're raising speeds. We've added sales teams a year ago. We've added TSRs. We've launched a great mobile product that you're alluding to. And we've been streamlining our operations. So what you see in Colombia is precisely us taking advantage of opportunities to drive postpaid and drive higher speed. It is a market that remains underserved in broadband, both in fixed and mobile, and that's the opportunity that we're taking.
I think if I could just add, it's interesting to look at, Julio, I can just add, it's interesting when we look at Panama, the business that we're buying there, where they do have, similar GDP, higher speeds, and significantly higher ARPUs. And, I'm not saying we'll get to those levels of ARPUs, but it's an interesting comparison to make.
Okay. Thank you, Team Mauricio. Thanks for it.
We will now move to our next question from Stefan Gauffen from DNB Bank. Please go ahead.
Yes, I have a question on El Salvador, where we saw already last quarter that the business was deteriorating in terms of service revenue. and you stated that you are taking action and expected an improving trend coming quarters. We see service revenue continue down this quarter. Can you just explain a little bit more what actions you're taking and why you're confident that you will turn this business around in 2019? Thank you.
Hey, Stefan, and thanks for that call. I'm actually in El Salvador right now. So if you see some improvement, I'll take credit for it. If it doesn't, then unfortunately you're just going to have to blame it on me and all on me. Listen, I like your question because when I think about these, I think of the way I talk to my kids when I get their report card. I have 3 young kids, and I usually tell them, it's got to be all A's, and every now and again there's a D there or a D minus, and I think that's what we have in El Salvador, a whole bunch of A's and then 1 D minor. And I'm using American terminology, but I'm sure you can figure out that we're not happy with that D minus in our scorecard. It is the one black spot. So yes, we're disappointed. Some of it we can blame on it being macro and the industry. It is a 4-player industry, mobile in El Salvador, so it's a little bit more difficult than it is everywhere else. A little bit of it is political. There are gang wars, going on, and as you can see, they're making the news these days quite a bit. But we've also been very transparent that some of it are actually self-inflicted wounds, execution issues. We like being very transparent, so we build credibility. And those came about from, migration of GS platforms. So what we've been doing is, we've been successfully fixing them. And that requires a lot of work to fix them, but I think we've got those nailed. What you're seeing in the result is a little bit of the rearview mirror on the effect that past mistakes have had. So you're not able to see into the future the correction, which basically has to do with stabilizing the subscriber base and letting the bad debt that resulted from it wash away. So you'll begin to see those improvements because of that, but also because we changed management, and I alluded to that, and I'm pretty pumped about the team that we put in place. We put in place a top-notch team here in El Salvador, and I can see that we're slowly but surely recouping some traction with subscribers. You can already see that in our operating metrics. Having said all this, and perhaps with the credibility that we've had in the past of turning every operation around, I urged you not to look at our report card for Q4, but rather look at it as a 2019 recovery, because timing the exact moment of this recovery is a little difficult. And with the credibility that we hope we're building, we're pretty bullish that we'll do that in 2019.
Okay, thank you.
We will take our next question from Johanna Alkvist from SEB. Please go ahead.
Yes, 2 questions, if I may. First of all, related to corporate costs. You mentioned that they increased a bit year-over-year. What is the how much should we see as a one-off, and how should we view corporate costs going forward? And then second question related to cable ARPU. You touched on the subject before, that higher speeds has a possibility to translate into higher ARPU. But do you foresee that? I guess there are mixed effects here, but what are the likelihood for a continued? Now you grow ARPU with 1 and 2% in this quarter. What do you foresee going forward? Is this the way forward, or should we see? What are the possibilities really for a continued ARPU increase in cable? That's my question. Thank you.
Yeah, so I'll take the cable ARPU one first, and then perhaps make a comment or 2 on corporate costs, and I think Tim can certainly help me there. Listen, on cable ARPU, I've done this in every operation. Cable guys know how this works. When you are sitting on relatively very low broadband penetrations, and high speed is the name of the game, but in our case, pay TV also had some room to maneuver. The name of the game is simply to give more for higher ARPUs and to create differentiated tiers. So as you upgrade your plan, you start giving higher speeds and you start moving the better subscribers, the more bandwidth-hungry subscribers to that higher tier. And that opens up the possibility for you to add new subscribers on your medium and lower tiers. And the name of the game here, Johanna, is to basically create space with higher tiers so that you can bring in new customers. And given the situation we're in our markets where we have very low broadband penetration, what we need to do is we need to continue to reach new subscribers, add volume while sustaining the ARPU. So as you look longer term, very, very, very much into the future, the name of the game is sustaining ARPU, slightly picking it up, but at the same time adding a lot of volume. And the way to do that is with higher speeds and on pay TV with high-definition TV, which is not completely launched in our market, meaning there's still a lot of demand for it, and of course next-generation TV products. That's Cable 101. It's been going on for decades. Now on corporate costs, just big picture before I hand it over to the team. I think on corporate costs, you've seen us be very, very diligent. We stopped doing all the stuff that needed not be done at the corporate. But we've also been strengthening our corporate. We have a lot more of compliance. We have more of a lot of cybersecurity in our corporate. And we've been taking advantage of all the savings to beef up some of the things that a corporate cost center needs to do, including driving the business increasingly from an operational and a CapEx point of view so that we get savings in procurement and we streamline the operations also from the center. So it's about doing a lot more with less. Tim?
Yeah, I think there's a couple of technical issues as well, Johanna. If you recall, the Q3 last year, we took an $8 million credit into the corporate costs. So actually, when you take that into account, plus we took a reorganization charge in respect of some wind down in London and Luxembourg. Basically our corporate costs are on the run rate they were last year, and we're pretty comfortable where they are.
We'll now move to our next question.
Operator, next question, please.
Certainly. The next question is from Kevin Rowe from Rowe Equity Research. Please go ahead. Your line is open.
Thank you. Mauricio, you raised your HFC homes passed guidance to 1.2 million from 1 million, which is great. You had previously talked about the 1 million being sort of the peak ramp, all you could do, and we're at 1.2. What's changed? How have you been able to squeeze out that additional homes passed target, and which markets is that delta coming from?
Yeah, so thank you for the question. It's called, it's clustering. When you have such a big build-out, the only way to get better at it is to try to cluster it more, because that gives you the ability to go faster in a given area. So back in the days when I was doing single country build-out, the name of the game was trying to hit a given city first. That's how you get the construction crews to be in a single place and you can go faster. The name of the game for us, because this is a multi-country build-out, is to cluster around countries. And we've done a lot in Colombia this year and a lot in Bolivia this year. So as you go to the numbers, you'll see that coming through. And we did quite a bit in Honduras last year, and that's where we're bullish on the turnaround there, and a little less in Guatemala. I'm going to take use of your question to just make a kind of a cleanup point on the math. The 15 million target of homes passed remains 15, and that, as I've said often, that's kind of what we see in the horizon. So it's more an outlook than it really is a ceiling. And that number is actually now about 1 million higher because of Cable Onda. So the Cable Onda acquisition doesn't change the target. So I'm confusing the numbers perhaps when I was trying to clarify them. The number now is 16, 1/6. It's 15 from before, plus about 1 million from San León.
Okay, but for this year, the incremental HFC homes passed that you'll achieve this year in 2018, that incremental 200,000, that's primarily coming from Colombia and Bolivia?
Yes. Bolivia is just on fire. Colombia is working extremely well. I mean, we showed you the numbers. We are now certainly on net positive territory in Colombia as a result of migrating from copper and as a result of just the new territories that we've built in Colombia.
Great. And a follow-up question on the new postpaid plans in Colombia. What is the hoped for impact on ARPU? Of course, this is going to help you. You know, the expectation is you will gain gross ad share, and hopefully it helps churn. But how should we think about ARPU impact as these new price plans flow through your base? And maybe a last one for Tim, the NASDAQ listing. Is there a timeline a hoped for timeline you can share on the NASDAQ listing?
So on the first one, and then I'll hand it over to Tim. The metric we look at in Colombia, surely we look at, net ads, from our base, from outside our base, prepaid into postpaid migration, net ARPU, etc. But the key metric I'm looking at daily is net added revenue. And we're shooting for a positive net add revenue as a result of this. We're also looking, so I hope that's clear to you, we're also seriously focused on NPS pickup. And we've seen a tremendous amount of NPS pickup, even if after just a single month of operations. And the reason we're so focused on that NPS pickup is because this is a long-term gain of making our prepaid subscriber base move to postpaid so that there is a more subscription, higher or longer lifetime value, and for us the ability to have a clean path to convergence. So this is connected to our long-term, to our cable bill. We want subscribers that are postpaid, that are subscription, so that our path to convergence is paid as a result of this strategy.
Yeah, and on the NASDAQ question, Kevin, we've been making really good progress with the SEC and our sort of preliminary filings. It's a process we don't have total control over, so I don't want to go into when we expect that to finish. But just to say that we've been, kind of really very happy with the progress we've made so far.
Just to say the obvious, it remains a 2019, Kevin, as we said from the beginning.
Understood. Got it. Thanks again.
We'll now take our next question from Sergey Glusevsky from GAMCO Investors. Please go ahead.
Good morning. Mauricio, you mentioned that Bolivia has been on fire, and obviously we saw strong revenue growth and market momentum this quarter and last quarter. Could you talk a little bit about the drivers and how sustainable these trends are?
Yeah, this is going to sound like a broken record, Sergey, but it just, it's the underpinning of our entire strategy. It is simply pent-up demand for pay TV and pent-up demand for high-speed fixed broadband and mobile services. The minute we build a new neighborhood with cable, we're selling it. And the lead proposition there, of course, is higher speed. The same has been true for wherever we have 4G network and we get a pickup in mobile data. Now, there's a couple of additional elements in Bolivia which help, but they're consistent with what we do everywhere else in our strategy. It's the combination of sales teams, both for mobile and fixed, and the fact that in Bolivia we've added exclusive sports, high definition, products. So in Bolivia, we've had now for about 3 years our Tigo Sports product, which is the exclusive local soccer produced with high definition and very high quality, and that's helping us with broadband pent-up demand. It is as simple as that. It's demand for broadband and demand for high definition good content.
And my second question is on your strategy in markets where you don't have a wireless business. So obviously right now it's just Costa Rica, but soon you'll have Panama. Maybe at a high level you could talk a little bit about your strategies there and potential for wireless offerings in those markets when that makes sense from your perspective.
Yeah. So I often say that I am perhaps a little uncomfortable being in a country when you are a mobile operator and you have no path to having a strong fiber-based HFC plant underneath you, because it leaves you unprotected into the future. But I'm very comfortable with the reverse situation, which is sitting on a nationwide cable plan that gives you optionality on mobile. And that's why we're so comfortable with our position, both in Costa Rica, but most importantly in Panama, which is, much bigger. And the situation there is simply it's a nationwide, state-of-the-art HFC plant with a significant market position and great high speed. So you're basically in the driver's seat there in terms of when and how and what are the economics of your moving to mobile. It's a matter of time, of course, and it's a matter of picking the right time and the right economics to do it. And it may be that the right economic is to do it with network economics, or it may be that the right economic is basically to do it with an MVNO until you build a strong subscriber base. We're in the driver's seat, and there's 4 operators in Panama, and it's also a matter of public record that the regulator is happy with a move from 4 to 3, being approved in legislation. So there is a meaningful opportunity there to do that. It's just a matter of being in the driver's seat. It's early days for us, as bullish as we are about the speed at which we're incorporating Panama. We also want to be conscious of the fact that we've got to learn a lot more about that business when we hit the ground running in January of next year. That's what I can tell you about our moving to mobile in those markets. I think I said Despacito. We had the call on Cable Onda, so I got to go back to that song now.
Thank you.
We will now take our next question from Lena Österberg from Carnegie. Please go ahead. The line is open.
Thank you. I was wondering if you could maybe comment anything on if you've seen any change in the macro environment recently. Some of your currencies have weakened, but I think most of your countries are still holding up well. And then, I'm sorry to come back to Africa. I know it's a small portion of your business, but do you have anything to say on the timing of the IPO in Tanzania?
I'll comment a little bit, and I hand it over to you, Tim. On macro, I think you're generally right. We are in markets that have been very stable from a political point of view and also from an FX and macro point of view. Relatively higher GDP growth than some of the bigger markets like Argentina and Brazil. Certainly more stable FX than those markets like Brazil and certainly Argentina and even Mexico to some regard. We've been pretty stable on FX. Anything, Tim, before we go on to Africa that you want to comment on macro?
I would echo it. I mean, I think FX has been the thing that has affected us in the past, and I think kind of in contrast to what's been happening around us, our FX rates have been relatively stable. There's a little bit of sell-off towards the end of the quarter for us, but essentially with strengthening oil prices, that's where Colombia's currency remains relatively strong. So So, I think the point with bringing Panama into the group, the amount of dollarized, kind of revenues and EBITDA within our group is increasing. So, we're less and less exposed, I would say, to FX.
Right, and always remember the remittances into Central America, Lena, which are pretty meaningful.
But no change in consumer sentiment or consumer demand that you've seen in any of your markets?
Well, I think the big one, which is, I think it's a matter of a very public record, is that consumer sentiment in Colombia in the last quarter, 2 quarters, has stopped going down and has begun to recuperate and become slightly in the upward trend. I think that's meaningful. And on the Africa IPO, Lena, I think the key point is that we work very closely with the Tanzania government to comply with the law and to work with them on the timing and the way to do our IPO. Very compliant and very much working with the Tanzanian authorities as we do everywhere. Tim, you're much closer to this process perhaps.
Yeah, I think we expect if we hit the timing that we're working on, that it will be by the end of the first half of 2019.
Thank you.
We will now take our next question from Bill Miller from Hartwell. Please go ahead.
Thanks. Nice quarter. I'm curious about the 3-year outlook. You've got a great new cable acquisition. Cable is growing faster than you expected. What do you think your growth rates? We can put it in EBITDA terms. You can put it in revenue terms, whatever. What do you think the growth rates will be, say, 3 years from now? If you want to use 2, that's okay with me too.
Yeah, Bill, thank you. It's a great setup question, but I think if I answer it specifically, I may end up in trouble with the SEC, and that's the last thing I want, because we've, as Tim said, we got a pretty good dialogue with the SEC, which is keeping our listing right on track. But I'll tell you this. I'm particularly happy about the last 2 quarters when our home business has begun to show its true potential. We've been building cable, we've been adding next generation TV, we've been raising speeds, we've been working on the ARPU, we've been adding subscribers, and we're at a point where we're hitting momentum. So when I look at that home revenue growing double digit and our mobile business driven by mobile data having been now for a number of quarters on positive territory, I become very excited about our future because I begin to see what we dreamed Millicom could be 3 years ago, a high growth company that has basically started to hit on all cylinders, whether it's B2B, even mobile, and certainly cable is right where I thought it would be. We're already a pretty meaningful cable operator. We show those numbers. We got $2.2 billion of cable revenue, and that cable business is growing extremely, extremely well. So I feel like our vision is beginning to show. And going forward, it's going to be a lot more of that because we continue to build, we continue to add subscribers, we continue to raise speed, we continue to manage ARPU quite well, and we continue to reallocate capital from Africa into organic growth in Latin America. So quite frankly, I couldn't be more bullish about our outlook.
Great. Is all of this sustainable at a high rate? When you say, we're going to become a growth company, growth companies grow high single or low double digits. Is that feasible given the outlook for cable, and how big will cable be, say, 3 years from now? What percentage will it represent of your total revenues or EBITDA?
Yeah, look, so when we look at that 4 to 5% service revenue growth that we're kind of hitting these days, what I like about it now was that unlike what our growth was
3-4 years ago. This one is healthy, and I use the word healthy. It is data-driven. It is driven by, if you will, the businesses of the future, and the legacy part of the business has been left behind. So it's now fixed and mobile data. It is good B2B. It's almost 70% subscription driven. So it is a high, stable service revenue growth. And I'll take the opportunity to say something that I guess, must be said, which is now that we, it was only about a year ago that we didn't really have service revenue growth. So now we're at stable growth rate, which is now giving us the opportunity to focus on operating leverage, which is another important part of our story going forward. It is starting to turn that revenue growth into EBITDA growth, which I think it's something that we can afford to and should be focused on right now.
Thanks. Really appreciate it.
We now move to our next question from Matthew Blockman from Bloomberg Intelligence. Please go ahead.
Yeah, hi there. Thanks for taking the question. I think most of what I had been asked already, but I guess just to follow up on inorganic growth. Obviously, Panama is pretty big. I think you've alluded in the past that there's a number of different options you have been looking at in the LATAM footprint. Do you still have fill-in acquisitions that are kind of on your list of things you'd like to do, and is any further move kind of contingent on getting some cash in either from Africa or just organic deleveraging? Thanks.
Yeah, great question, Matthew, and thank you for that. I think, in a sense, despite the great opportunity that I'm happy we're able to finally tap into with Cable Onda, it actually doesn't change one single bit what our strategic plan is. And let me explain what I mean by that, because I think the one thing you can count on us is to be consistent and transparent and hopefully credible. We're extremely IRR driven in everything we do. And we've said very clearly from the very beginning that we are all about reallocating capital from low IRR, non-strategic areas like Africa to high IRR, high strategic areas like Latin America. And effectively what we've been doing for the last 3 years is just about that. We've been allocating capital to high-speed data networks, which are high IRR. We just went through the math for cable, and that has been basically organic reallocation of capital into broadband. And Cable Onda is nothing but the same. It just happens to be inorganically. That it's reallocating capital from the free cash flow that we've been able to free up, and from the transactions that we've done in Africa that gave us a strong balance sheet, and into a high IRR country that helps us diversify in Latin America, like Panama. So it's the same strategy, simply adding a layer of inorganic element to it. And that's the point, Matthew. That's our big picture focus. Very clear. Move away from low IRR, no strategic focus like Africa, into high IRR strategic focus in Latin America, where the opportunity to drive revenues out of pent-up broadband low penetrations is very, very clear. And whether we do it organically or whether we do it inorganically, like we did with Cable Onda, we'll have a single common denominator, and that is the opportunity itself needs to be a high IRR for us. Otherwise, we wouldn't be consistent with the strategy. Now, we need to continue doing that with the same level of prudent management of our cash flow and our leverage as we have in the past. And nothing has changed in that. We've been very consistent on where we want our leverage ratios to be, right around 2 times. And we've said that we will temporarily move higher to around 2.5 where we see it today when great opportunities like Panama come about. And so despite Cable Onda, or precisely because of Cable Onda, I think what you see is a pretty meaningful and pretty consistent capital allocation leverage story from us. And while there was a little bit of Africa in your question, perhaps Indeed. I'll take the opportunity to answer the question there. You know, we've been pretty active on Africa, and I think we've solved for a lot of the issues there. We've done a few transactions, and as the team alluded, we got meaningful free cash flow coming out of Africa. But our plan remains the same. It's about reallocating capital. And when you look at where we are in Africa, I think the way I look at it is we're no longer in the qualifying rounds of our World Cup soccer in terms of our exit processes there. It's more now like right in the middle of the World Cup itself, and we're moving into the quarterfinals, if I may use an analogy there. And I think we got pretty much all the A teams in there. So we're I think gaining traction there as well. So stay tuned there for updates on that.
That's great. Thanks for the comprehensive answer. Thank you.
Thank you. Unfortunately, that is all the time we have available for questions. I would now like to hand the call back to Mr. Ramos for any closing remarks. Please go ahead, sir.
Oh, thank you and everyone for joining us today. I'm going to sound like a broken record, but one that I like playing. We're very pleased. Our service revenue growth, 4.7 for the quarter and 4.5 year to date is pretty healthy. All countries are positive, and we're working on El Salvador. That's pretty positive as well. All three line of businesses are growing, with mobile positive now consistently, and homes certainly kicking high stride. Colombia is going well, both on mobile and on cable. We finally, I think, got that one right. Home growth is solid. It's double digit. Our cable business is already pretty big, just like we wanted it to be, and it's growing quite healthily. And we continue to focus on our growing equity-free cash flow. So thank you for your support, and we look forward to talking to you towards the year end.
Thank you, sir. Ladies and gentlemen, this concludes Millicom's Financial Results Conference Call. Thank you for your participation. You may now disconnect.